stock market was a roaring performance last year when we saw the S&P 500 up 24%, leaving many on Wall Street scratching their heads, wondering what happened and why didn't they predict it. Where our guest today not only forecasted it, he accurately predicted it, and he is joining us today because he has all kinds of surprises to tell us for 2024. Welcome, everyone, to Buy, Hold, Sell. I am your trader, Todd Schoenberger, and I am joined by my friend and co-host, Tobin Smith, on a sunny and very chilly Scottsdale, Arizona.
Yes, it's cold out here, damn it. I can't believe it.
well, you do look tan, though. I will say that.
Thank you.
So, and with us today, we have Dr. Ed Yardeni from Yardeni Research is coming back to Buy, Hold, Sell. Welcome to the program, Dr. Ed.
Thank you very much. Nice to be here.
Absolutely. Well, I got to say, once I told Toby that you were coming onto the show, he was foaming at the mouth. He was sending me all kinds of messages.
Okay, foaming at the mouth is not the right description. Okay,
he was that mad.
Yeah. Well, he was that excited, I should say, because he just so wanted to. He had a million questions for you, and I was getting inundated with it. And I just said, Toby, you lead off with the Q&A today. So I'm going to turn it over to Toby now. That's
with me,
Dr. Ed. You get the victory lap, but the thing that always most impressed me is that. On other financial media, shall we say, they'd have a clip of like Mike Wilson talking about, the 3,800 and the 3,600. And then they'd have you on about, 2 segments later, and you'd be the nicest guy in the world because that's your nature. Whereas I would have said, well, holy crap. Number one, has he been right in the last, 12 months, 24 months? No. Why would you believe him now? What did you get that Mike, Mr. 3,800, then 3,600 did not get?
Well, I think, first of all, it's sort of a different investment philosophy. I'm actually surprised the extent to which Wall Street encourages people to get in and out. Well, I guess it shouldn't be a surprise. They make commissions on that.
Yeah.
But the problem with the guys who get it right and tell you to get out is they always forget to tell you to get back in.
Right.
And I have to admit, I've got a really, really good track record of calling bottoms. I'm still working on the tops, but I've called a few tops along the way. But look, I think what most economists missed is that the economy is resilient, and yet at the same time, we did see that the economy handled some what I call rolling recessions that started early last year when the interest rates. Years change. We're at the beginning of the year. So it's really started in 2022 when the Fed started raising interest rates aggressively. That's when all the pessimists really came out and said, well, this has got to cause a recession. And I've been around for a while, and I remembered back in the mid 80s, we had a rolling recession in Texas when oil prices took a dive.
Yeah.
And I also pointed out that, the naysayers, look, some really smart, well plugged in people like Jamie Dimon, during May of 2020 was saying the consumer looks good now, but when they run out of their excess savings, we're going to have a consumer-led recession. And I was looking at my personal experiences. I'm a baby boomer, so maybe I have an advantage in the sense that I know what about 75 million of us are doing. And what I noticed is a lot of my friends are retiring. They only had a couple of kids. I had 5 kids, so I have to keep working for a living.
I still have to work.
But the ones that had 2 kids, their kids are young adults now. They don't need to be financially taken care of. And all of a sudden, my friends are wondering, well, now that we're retiring, why did we save all that money? Oh, yeah, to go out to restaurants and to travel and to, make sure we're okay to go to the healthcare providers. And so the economy has had a lot of employment strength in those areas. And I think they've missed the demographics. I think they missed the fact that there was a pandemic, and the pandemic had some consequences of causing an inflation spike, which was a spike. I believe that it was transitory, and so it has come to pass so far.
Yeah. Well, I've been working on this basically for the last couple of years, which it drives me completely nuts. How do we compare historical numbers with a pandemic and then essentially World War III invasion, et cetera, and expect the same outcome? I mean, what is it? The Einstein thing? When the numbers change, I change my mind.
Yeah. Well, I think that's it. I and those who got it right were very much focused on the data. And the data just continued to confirm that the most widely anticipated recession of all times turned out to be the Godot recession so far. It just hasn't shown up.
The
And
Godot recession. Thank you for that literary elocution there.
now, speaking of history, I think if you have a historical bent of mind, then the events that you just mentioned are very reminiscent of what happened, in the early 1920s.
Right.
And this decade kind of rhymes with that. I think we're in the roaring 2020s. It didn't feel like that the past couple of years, but I think by the end of the decade, we're going to look back and conclude that technology solved a very big problem for us. We have a shortage of labor, particularly skilled labor, and productivity, I think, has already started to make a comeback in terms of productivity growth. And if I'm right about that, then it's going to turn out to feel like a pretty good decade. And I think the stock market started to discount that possibility really in October, November of last year, when the bear market ended. People started getting excited about artificial intelligence, but there's lots of other technologies that I think are coming to bear on leading to a better
Sure.
productivity growth. And productivity is a magic, elixir. It provides downward pressure on inflation. Wages go up relative to prices. The profits are strong. So, look, pessimism gets followed. It sounds like they know what they're talking about, but the reality is, the world just doesn't end the way they think that the pessimists.
Yeah, I mean, just to follow up on another point of that, of sort of the historical context. I mean, another one that drives me nuts is to compare the 1983 economy to the 2023 economy.
Yeah. I was there.
I was there too.
Yeah.
I was there too. We had 18% yield on the 10-year.
Yeah.
We had a 41% manufacturing economy.
Yeah.
We had gas prices that from oil. Strikes. Yeah. So it almost comes down to the same thing, Dr. Ed, about, we have 76 million people in the United States who are getting some form of a pension every month.
Yeah, right.
We have 40% of the homeowners don't owe a dime on their mortgage.
That's a point I've been making. Yep. And don't forget, interest income is at an all-time record high for individuals. So while the pessimists are saying, "My God, look at how that government interest is going up," and they're right, it's a terrible development. But the flip side of that is somebody is getting that interest, and these large federal deficits have actually been one of the reasons the economy hasn't fallen into recession, because there's all been all this stimulus. But let me make one other point, and that is, what the pushback I get is typically the pushback is on the headline news about fiscal and monetary policy and how the policymakers are just out of control. I think the Fed is back under control, but the fiscal authorities clearly are not. And my kind of response to that is, I agree with you, but look how well this country continues to do despite the clowns in Washington. That's really the amazing thing. And what I tell people is, like, you and I wake up in the morning, we go to work, and all we want to do is do good for ourselves, our families, our communities, our customers. And we do that. Yep. And we do that despite the obstacles thrown at us by Washington.
That was very nicely said. Hey, here's another one that gets me. They were comparing the Russell 2000 to the S&P 500. Mm-hmm. And, Kathy at Oakmark has been rather talkative about how the indexes, because
Kathy Wood,
yeah. How the indexes, because they're market weighted, are totally screwed up the whole system. And I think she's got a point there. But the one that another one that drives me nuts, I'm nuts today, is sort of like the Russell 2000 index. Well, first off, they come up with this fakakta EPS number because they don't count the actual companies that don't make money. The only EPS they use. So how can you compare that to the S&P 500, right, where all of the earnings are compared? Number one. And then number two, the other one, there was a good article on this yesterday, I think, in MarketWatch, about, but we also have the law of large numbers when it comes to went part-time to school at Arizona State. We have a economist out there who came up with this idea that, network effects really work. And as your network effect gets stronger, your customer tie-in is stronger, your profit margin goes up, and the incremental sales, particularly when you're adding different software products in there, is zero. And how can you compare economy like S&P 500 and the network effects with much smaller non-network effect Russell 2000?
Yeah, that's why my preference is to look at the S&P 600 and the S&P 400. Those, that's a far smaller number of companies, and they do include companies that are losing money. And so when you do your calculations on valuation multiples, you get actually a lower PE than you do with the Russell 2000. So I'm not a big fan of the Russell 2000. I'm much more of a fan of the S&P 600 because I think that the data is more easily available and more easily can be interpreted.
Yeah. All right. So that's a segue to you, Todd. What's your prediction for this year?
Well, let me just go back to the beginning of last year. I was talking about 4,600. We got there by July of last year. And I said, you know what, I think maybe it's going to stall out for a little while. So instead we had a 10% correction. I came pretty close to calling the bottom in that correction. And we had ended up at almost 4,800, didn't quite make a new high in the S&P 500. Now I think we are going to make a new high this year, around 5,400. So I'm still bullish. I think the first half of the year this time could be the rough one. As you know, the bears at the beginning of last year were predicting that a recession is finally going to happen, and they were predicting that the first half would be pretty bad and that things would start to recover in the second half as the market started to discount a better economy in 2024. Well, kind of worked out the opposite. We had a really good first half, then a kind of a difficult correction from July 31st to October 27th, then a melt-up rally. And now I think we've discounted a lot. Everybody's optimistic and happy, which kind of brings out the contrarian in me. Right now the attitude, at least at the end of the year, was we have nothing to fear but fear itself. And my attitude right now is, oh yeah, so maybe I have to worry that we have nothing to fear but fear itself.
No fear.
Yeah, if people
so you're the new FDR.
Well, I think sentiment is important, and I think to the extent that we had a melt-up rally at the end of last year, I think we need to digest it for a while. And so I do think the market's going to be kind of sideways, maybe even with a mini correction of 5%. But I think but we'll end up the year in the second half with a really good rally, another Santa Claus rally that starts early.
Okay.
Wow.
Well, I like
That's
that.
the Easter Bunny rally or something.
Easter Bunny rally. There you go. I like it. All of that. So listen, let's leave it there on this block, guys, because coming back with Dr. Ed, we need to break down that 5,400 target for 2024. Obviously, there's some clear challenges there, but we also want to get into, we have a presidential election cycle. What's that going to mean for the stock market? But with us today, we have Dr. Ed Yardeni. He is with Yardeni Research, and you can go to YardeniQuickTakes.com for all of Dr. Ed's research.
We just call him Dr. Right, okay, Todd?
Yes, he is. Absolutely.
Don't jinx it. Don't jinx it. You're only as good as your next call.
There you go. There you go. Well, we'll get into all of that after the break, so please stay with us.
Sure.
All right, that was...
Buy, hold, sell, brought to you by CrossCheck Management.
We give game day a whole new meaning.
What does it mean to be a leader?
It's taking my first solo flight.
At the University of North Dakota, we lead our own way.
Welcome back to Buy, Hold, Sell. Well, this is our first episode for 2024, and we're starting off on a very high note. We hope the rest of them are going to be like this. We have some big-time guests coming up over the next few weeks to kick off
Promo,
the year.
Todd. Nice promo. Keep going.
Yeah, definitely. But really no one bigger than Dr. Ed Yardeni, because he called it right in 2023, and he's got some great predictions for 2024. Dr. Ed, I want to get into that a little bit, because you have this number that's out there, 5,400 on your target for the S&P 500. It is an election year. We're hearing a lot of people talk about rate cuts. Are you taking, how much is that being attributed to your forecast?
Well, it's rather independent of what happens in Washington. Again, my view is it's amazing how well the economy is done despite the politicians. And so, we've had presidents like Obama and Trump, and very partisan in terms of that there were people who loved them and people who hated them. And if those people bet on put their investments decisions based on the politics, they would have missed a heck of a good stock market rally. And so you really have to, when you invest, as much as possible, try not to be political about it. Just kind of focus on what matters to the markets. So I think with regards to the election, I'm looking right through it, and I see the market getting to 5,400 by the end of this year for the S&P 500. And then you didn't mention this, but I'm talking about 6,000 by 2025. So I'm very much in the roaring 2020s camp.
Roaring? Is that the next book, Dr. Yardeni? Is that the next book? The Roaring 2020s?
Well, I started talking about that in 2020. That might be ahead. And then all of a sudden this inflation monster occurred. I argue that it was probably going to largely related to the pandemic, and that would abate, and that we will resume the roaring 2020 scenario. And I think that's worked out pretty well, certainly in the stock market. But again, we've had some pretty controversial presidents of late, and that's not necessarily going to stop. The country's become very partisan, clearly. And yet, despite all that, look at the market. The market's up actually 50%.
Right.
And earnings wise, I know you always have an earnings number for the S&P. What is it, and how aggressive Yardeni is it?
Well, I have to admit my numbers seem far-fetched, even delusional. But for 2023, I think I've come pretty close, better than the pessimists. I was using 225. It's probably going to come in something like 220, 222. It's not coming in anything like the 180 that some of the pessimists were talking about.
We'll cut you a slack for 3 points, okay, Dr. Ed? I mean, come on.
And then for next year, I got $250 for this year. Wow. That's what happens when you cross into a new year. You forget what year you're in. But the 250 for this year, and then 270 for 225, and then 300 for 226, which is really what drives my optimism on the where the S&P can go.
So and that's because of the structure of the economy, the structure of the companies.
Absolutely. I've got this this notion that when you invest, you have to kind of believe in your companies that they're all technology companies. What that means is that they either make technology or they use technology to increase their efficiency and productivity. If they don't, their competitors will do that and put them out of business. So I think when you look into companies, you want to really look at their technology budgets. What are they actually spending on? How are they dealing with labor shortages? And the ones that do that most effectively will be the winners. I mean, there was a lot of talk that higher interest rates are going to cut into margins and higher labor costs are going to cut into margins. And instead, we've had a very mild earnings recession, which was driven entirely by the profit margin shrinking. Right. But it wasn't a very long recession last year. And now I think profit margins are starting to expand again, kind of confirming that companies are doing a really good job of dealing with some of these challenges of cost inflation.
Yeah, I work with a company called Blue Yahoo, and they Yonder, I'm sorry, Yahoo, and they are using a technology just to support your point. They're a distribution company, right? Technology, and they brought a new technology in that is essentially sort of is getting close to AI as you can get for their warehouses. First off, they called the people on the floor pickers. I'm not quite sure, they could have come up with a better name in my opinion.
Yeah.
But the people on the floor, they cut down they increased the productivity by 70%.
Yeah.
They cut the quit rate, because that's the thing that really is costly in that business.
Sure.
That the people only last 9 months to 12 months, and the ROI on that investment, $1.5 million investment, is something like 60 to $1.
Right.
And that is not an outlier now. Now they've gone to all of CBS. And then once CBS does it, then, ProLogic is going to blah, blah, blah. So I think your point's well taken.
Well, look, my little company couldn't do what we're doing without technologies. As a matter of fact, I think one of the things that's unique about our company is we've got this really cool chart system that automatically updates the charts when the data becomes available. We don't have to do a thing, and it automatically gets uploaded onto our website. So we have this section called our charts, which right now is open to the public. And it's, we've got the mega cap 8 on there. We've got individual stocks. We just keep adding to it. And, it's hands-free. It's just once we actually design the chart automatically updates. We don't have to readjust.
I want to go back to the old days, but do you remember when the assistant to your assistant was the one who went down and got the charts, and then
I was that assistant, and I remember that we had a draftsman who actually had a big board, and he used tape to make the charts. And then when he gave it to us, and I had to take it across to the printer had to take a photograph of it and somehow put it into the publication. And there was a weekly publication. Now, I've got the technology to just get out information to my accounts immediately, which is why I call my product YardeniQuickTakes.com, because I can give you a quick take and keep it short, not take too much of your time. So I just did a commercial. I'm sorry about that.
There you go. No, it's great. Well taken. Todd, I'm sorry. Go ahead.
No. A question for you though is that with Yardeni Quick Takes, I am curious. Your clients are, because we keep talking about the $5 trillion that's sitting in money markets.
Yeah.
Of your clients, they're clearly seeking guidance on the equity side from you. Mm-hmm. But are you getting any type of feedback as far as, are they still contemplating whether to get in or not, or are they in? I mean, because I'm trying to get a gauge of what people are thinking that are still on the sidelines. Well,
I think again, I'm data dependent, and I also like to talk to taxi drivers and people I'm in elevators with if they're not staring at their phone. You get a lot of information just by talking to people. They don't have to be even people that you recognize. Just be nice and start a conversation. You learn a lot that way. But the data is, at the end of the day, is what I really put a lot of weight on, rather than anecdotes. But if the anecdotes and the data point in the same direction, that's great. And what I see is nobody's really excited about this stock market in terms of, cocktail conversations or, relatives saying, what do you think of the market here? So I think that's sort of a healthy development. On a short-term basis, there are too many bulls in the market, but there's still a lot of people that aren't participating. A lot of people that might have listened to Wall Street's pessimists and, never got the call to get back in. And those people are sitting in money market funds saying, hey, at least I'm getting 5%. Soon it might be 4%. Soon it might be, 3.5%. But they have missed out on an awfully good bull market. I think what the market's proven once again is that unless you're a day trader and know what you're doing, if you have a day job, you really need to be a long-term investor in the market and focus on quality names, quality stocks. And, if they take a big hit during a correction or a bear market, just grin and bear it, because they come back. And when they come back, they can all look at how a lot of these stocks just absolutely roared since the end of October.
Yeah, I'd also add that I uploaded a variety of managed accounts this week or I should say people who work for me, since I wouldn't trust myself to do that myself. And when I'm going through their 2023 numbers, I'm saying, so you know that all that interest in your taxable account, you're going to have to pay taxes on.
Yeah.
And a number of these people are from California and are very high income. So you didn't earn 5%. I just want to share that with you, okay?
Yeah, that's
and
right.
After inflation, you got a negative return. And did anyone ever explain that to you? No.
Yeah, that's right. I mean, it's very important. If we all have to be financially astute, we all have to have some education on the financial system and stocks and bonds and how they work. But you don't have to be a day trader to make money. You know, some of them do, some of them don't. I guess I'm in the Warren Buffett camp, the Professor Siegel camp that believes that you really got to hold on to stocks for the long term, and bonds. You know, you do have to do some timing. It turns out that buying a 10-year bond at 0.5% back in 2020 was actually a disaster.
You're right.
You know, a lot of people did jump into the market when it got close to 5%, and even a yield around here is fairly attractive if I'm right, in that inflation isn't going to go back up. It's going to keep coming down, and with productivity making a comeback, we can actually have some deflation, which isn't a bad thing. Central bankers have this bizarre obsession about avoiding deflation, but deflation can be related to productivity, could be related to an abundance of resources because of technology.
How do you respond to the issue of, though, onshoring and reshoring and de-Chinization and deglobalization? Does that not, at least in the product side of the equation, add costs that gave us deflation for 20 years?
Well, it's all an interesting theory, but the reality is that we haven't completely deglobalized. We still do a lot of business with China. And that's been a very important insight to my work, because I pointed out, you know, this is the other thing that a lot of economists and strategists missed, is they all concluded, well, the Fed just raised interest rates 500 basis points because inflation's out of control. There's no way that the Fed's going to bring inflation down without a recession. And I said, well, you know what? There is a recession out there. First of all, we've had rolling recessions in the US, but not an economy-wide recession. But China has had a very bad recession. They've had a property bubble that burst that's bigger than anything Japan did or the United States did. And they're experiencing deflation. And you know what? We still buy a lot from China, and we're importing a lot of deflation from China. So goods inflation came right back down once the ports got cleared, and once people decided, you know what, we don't need any more goods. Let's go traveling. Let's go let's go see a Taylor Swift concert. Let's go, you know, check our health at the doctors. And as a result of that, inflation's come down dramatically. And so globalization is certainly an issue, but I don't think we can describe the current situation as deglobalization. And a lot of deglobalization is simply manufacturers leaving China and going to India, Vietnam, Mexico. And so there's still a lot of globalization. But, you know, at the end of the day, globalization was all about cheap labor, particularly in China.
Sure.
But nobody really has cheap labor, certainly not in China. Maybe India does. But there are a lot of costs involved in doing business in India, like the infrastructure is not so good. You know, getting from one street to the other could take you an hour. But they're working on all that. Yeah. But onshoring is a good thing for us. There are national security issues involved there, and I think we're going to find that the technology is going to solve the global problem of a scarcity of cheap labor.
I like it. Well, this is excellent. Well, terrific guidance, Dr. Ed. As always, every time you're on the show, I know the audience gets a lot out of it. So how can the audience find you, Dr. Ed?
Well, they can go, if you know, just to keep it simple, they go to Yardeni.com, and there we have access to our institutional business as well as our individual investor business. So to the extent that it's individual investors, they might go there, and that's where they can see quick takes.
Can I get a quick sector Analysis, I know that's not your forte per se, but
Yeah.
you know, financials versus cyclicals versus blah blah.
Yeah, well, I have liked overweighting information technology, and I would still do that, and take any opportunity of a sell-off to add to that position. Financials have looked good to me since the banking crisis. I didn't think that was going to turn into a classic credit crunch. The Fed came in a matter of days and provided a liquidity facility that stopped that from happening. And now, for all the talk about the Fed is still restrictive, the fact is the bond market's not restrictive. Mortgage rates are down, and I think we're going to see some activity there. Industrials look good from the onshoring perspective, and whether you like it or not in terms of what the Biden administration has done on the fiscal side, the reality is there's a lot of money being thrown at onshoring, which is great for industrials. So go with the flow.
I like that. Well, that sounds like it's some great advice. So everybody can go to Yardeni.com or YardeniQuickTakes.com. We will have those links in the description.
Okay.
And we'll send the audience your way, Dr. Ed.
Thank you.
And I just want to make sure we got the numbers right. 5,400 on the S&P this year, 6,000 for 2025, and then even higher possibly in 2026.
Let's do it 2 years at a time.
Your lips to God's ears, Dr. Ed.
I'm trying to get that exclusive. That's all.
Well, in the roaring 2020s, we may very well have a melt up that gets us to levels that even I can't imagine, but then that might set us up for a decline. The way the pushback on the roaring 2020s I get is from naysayers is, yeah, but look how badly it ended. Well, we still have some time, and we'll discuss that possibility along the way. I'm not denying that things can go wrong. I've been in the near term, I'm very concerned about what's going on in the Middle East and how that's becoming a regional war. I am very concerned about the debt and the deficit, but I'm pointing out that it's not something that's going to cause a calamity immediately, but it is certainly a concern. So the pessimists, I have to give them credit. They do a great job of telling us what can go wrong, and I follow them very closely and try to provide some balance. That's all I try.
Yeah, well, look, as long as we have roaring 20s without prohibition, I'm in, okay?
I like that.
Absolutely. I have to agree with that statement. Well, that's a great way to end the show. So, Dr. Ed, thanks again for joining us on Buy, Hold, Sell. We cannot wait to have you back to follow up on this discussion.
Thank you very much.
Sure.
Absolutely. And on behalf of Tobin Smith and Dr. Ed Yardeni, I am Todd Schoenberger. Thank you once again for joining us on Buy, Hold, Sell. We'll catch you tomorrow on Jobs Day. Take care. All right.
Buy, Hold, Sell, brought to you by CrossCheck Management.